Good morning. Thank you all for joining us. It's hard to believe the week's over. It's already a Friday, and we're glad you could jump on this call. We just thought there was so much going on right now that it was important to touch in with you and just make sure we could answer any questions that may have come up. As always, if you raise your hand, we will watch for that and we can unmute you to ask questions, but preferably the chat feature is wonderful. We'll go through that as we're going and answer questions as they come up or at the end, whatever fits the best. So I'm going to go ahead and turn it over to Dave, and please don't forget to ask questions.
Thanks, Jen. Hello, everybody. Interesting week to say the least. And so again, we just thought that it was good to reach out and talk a little bit. Yes, I've got some slides coming up to hopefully kind of set things in place, but I just want to talk about this banking crisis just for a second. First of all, you've heard endless talk about this, some of it complete nonsense and some of it political. You know, it's the Democrats' fault. It's the Republicans' fault. Let's see if we can take this crisis, just like a pandemic, and turn a virus into a political baton. Completely absurd. And of course, in that case, it was really tragic because millions of people died because it was political. Instead of coming to conclusions and working for solutions that maybe, you know, we got to shut down this group of scientists and so on. We all know that. But in the financial world, it's dangerous too. It's super dangerous to your peace of mind, number one. Number two, there's a lot of misinformation on both sides of the aisle. There really are. It really is. And Wall Street can't wait to have crisis like this and to yell and scream because nobody, if you remember one of our past Zooms, we showed this slide of how the ratings go up on CNBC and how nobody watches, nobody cares when markets are quiet or going up. Nobody cares. But throw a crisis in the mix and woohoo, everybody can't get enough data. Not knowledge, data. Just, well, that's what's happened. What happened here? And we're in a situation where we don't really know. We don't know what's happening. And the reason we don't know what's happening is because there are thousands of banks out there. Thousands. So we lose one that is completely absurd. And this is not a political statement. They spent $75 million supporting Black Lives Matter. Now, that's not even a political statement. We're taking the bank money, which I think they probably wanted to have that back now. And they didn't even have a risk officer. It's absurd. Operating a bank with, 12 board members and none of them has banking experience? Unbelievable. Just check a box and put somebody on there, because that's what we're trying to do, is be the most awoke bank. That's not banking. That's stupid. And is that one off? Maybe there's more, but does that make it a systemic risk? No, it doesn't. It makes them stupid. Just really stupid people taking risks that we wouldn't have expected. And regulators that aren't watching because, well, they're nice people. What would they be doing wrong? They're in San Francisco and they're not even watching in their own neighborhood. It's terrible. There's plenty of blame to go around, but it's not systemic. This isn't 2008, regardless of what you're reading. And we'll talk about that some more as we go through. This is not healthy to be running around listening to nonsense on the left or on the right. It's not. This is not the end of the world. It's not the end of our banking system. Are they going to overregulate? They always do. They always do. Knee-jerk reaction is, we need more government. We need more regulation. That's always the reaction. But what about all of the problems that could be caused by that? Is that what caused it? Was some of the changes? Well, if we're looking at this from a political basis, why wouldn't you just want to bash Trump and his administration? He personally went there and said, we want those banks to lend badly and behave terribly. No, but it's easy to blame. It's easy to blame Barney Frank because of what's going on at First Republic. This is easy if we want to turn this into politics. It's difficult because you don't know what the balance sheet really is for KeyCorp, for US Bank, for other regionals, big banks. We don't know. And even if you go to the banks that everybody assumes, I think correctly, are incredibly safe, incredibly liquid, where everybody's throwing their money, JP Morgan, etc., their stocks are down massively too. Why? Because everybody, first of all, runs for cover and then dials it down. We need some time. There's just no way we're going to be able to decide what all the balance sheets look like in a week. Can't. So you shoot first, ask questions later. Figure it out later. But it's not going to run JP Morgan out of business. Do we have moral hazard because of this crisis? Of course we do. We always do. But I don't know if it's right or wrong to say we need to guarantee the deposits. Would that have caused more panic? I don't think so, but I don't know. Because what we don't know is how human beings are going to react. So let's talk a little bit about our emotions, how we need to be calm, because I want to remind everybody, and some of these slides you're going to see remind us too, that our emotions are the most important thing in investing. Not what you know, not what you know and you can trade, and we know this squiggly chart is going to give us a head and shoulders, whatever. None of that nonsense. I find this an interesting quote too, right? Sir Isaac Newton lost a fortune. He can calculate the motions of heavenly bodies, but not the madness of people. Isn't that just super true? Totally. Sorry about my phone. Forgot to silence it. It's amazing when we think about how we sit around and quote billionaires. Well, this billionaire said this. Okay. Well, what did that billionaire do? Well, he made computers. He figured out a way to market little boxes and made a fortune. Okay. Well, what does he know about banking or what have you? Nothing. About the market. Nothing. Absolutely nothing. But we equate this in some weird way that, okay, good. I'm learning from Sir Isaac Newton of the day of selling boxes to people and making lots of money doing that, or iPhones or whatever, how something completely unrelated ought to be. And that's human beings. We don't know. But our emotions are everything. And I mean everything in investing. Let's go to the next slide. This is the, if you will, I've shown not this slide, but another one with all the people turning on CNBC because we want to hear the experts. Like Jim Cramer come on and go, oh, the market can't possibly go up in the morning. His head's on the desk and oh my gosh, it's never going to get better. Not until it was Ebola, I remember, because I saw it in the morning. It's like, oh, until Ebola is solved. Ebola? That's in Africa. Okay. But the market's down and so we're good. Well, anyway, that marked literally the bottom of the market. It shot up in the afternoon. And then I happened to be, walking by a TV and I saw him in the afternoon, happy dancing. Why? Because the market had bounced that day. So we pretended to be on top of the market. Now I know he is the, what did his fellow broadcaster call him? The Reverend Jim Cramer, who is the founder of the church of what's happening right now, this second. But this isn't just him. He happens to be the most famous one of the people that babble, just babble all the time, parrot each other, talk about it. But what do? You turn it on, you listen. And they're wrong more than a coin flip. Why would we have this in our heads? Why are we doing this to ourselves? What we're listening to is active misinformation. It's wrong. It's wrong more than a coin flip. So what I want to do is I'm going to get more wrong information, put it in my head, and that will help me do what? Have clarity of what? Of a difficult situation. We don't really know what's going on right now. Let's take a deep breath and just relax. Things always work out. But what do we do right now? What do we do right now? Oh, good. There's another Wall Street expert on the TV telling us what? One, what we already know with great certainty. What's going to happen? No idea. And normally they're smart enough to not really say with any certainty what's going to happen. They'll hint at certain things. You'll know because then they can come back and go, we called it. We called it right. Or they can deny they were really bullish when they were. But you know how the game is played. We don't have to play it. It's not helpful. It's just not helpful at all. Okay, now what does that do to us when we when we play that game? When we play the coin flip game, let's lose to the coin flip. You've seen this chart a zillion times. We talk about missing the best days or just staying invested. I think sometimes it just helps to remind us how bad we really are. I've also shown many times a chart that shows that the worst days are right next to the best days. And there's no way you're going to trade it. The idea is you're going to go step aside. Well, I'm pretty sure by the end of the year, we're going to find this week alone, just this past week, that the NASDAQ, that the Microsofts, which is up huge in the past couple of weeks, and monstrously since the bank crisis came out. Google, Apple, Amazon. Amazon was up huge yesterday. But there's a banking crisis. What's going on? All right, so let's talk about this just for a second. Let me finish this chart, and then I'm going to come back to that. If you miss 5 days, it's $240,000 difference, for crying out loud. On a $100,000 investment for the last 20 years. 5 days. You can't do this. Just stop even thinking about it. What do we do now? What should we do? Should we go to the sidelines? No. You should not. And I don't know anything that shows it better than that. Because this is us. This is us. It's terrible. Absolutely terrible. Okay? Now, let me go back to this a little bit, okay? As we see this in this time right now of what's going on with interest rates, why is this banking crisis happening? All of those things. There's a couple of things that we have to really try to wrap our minds around. From an economic perspective, we did the wrong thing for so long that these are the repercussions on the backside. Things that the Federal Reserve, they're going to raise interest rates until something breaks. Well, it just broke. Broke last week, last Friday. Broken. Now we got to figure out what else is going on. But it wasn't just last week. Because the Federal Reserve kept interest rates at zero for way too long. That's not a hindsight thing. They even said that inflation was not transitory and wouldn't change their mind. They wouldn't stop injecting trillions of dollars into the system. They just wouldn't stop. It's the weirdest thing. And they're never, well, why did you keep going when you thought that was a bad idea? Why did you? Nobody ever asked. I literally have never heard anybody ask Chairman Powell why he did that. It makes no sense. Unless you put a political wrapper on it, maybe it does. But we have these horrible decisions being made from the president's Inflation Reduction Act, which is nothing more than another boost of money into a system that's already on fire. Let's throw gasoline on it. It was bad decision making. Use a crisis to put legislation in place that hurts the economy, but at least it's in place. Because Congress isn't going to vote for all of these other programs. Let's do this. Use a crisis. That goes back to Trump too. These are bad decisions, locking down the economy and then watching things break. And then we go, wow, that is really, you mean we can't just throw $9 trillion at it and then it just goes away? No, it doesn't. It never was going to. And now we're on the backside of that. And so far, not a lot of things are broken, but inflation is real, present. And I want to one more time explain why, even as the news often says, inflation has pulled back. Pulled back? That's like me saying I'm the greatest human being compared to Jeffrey Dahmer. It's an absurd comment, because what we're really saying is 9 and now 6, which is way too high, 6% inflation. If it really is 6, well, okay, let's just call it 6. So we were horrible. Now we're just really, really bad. And it really, really hurts middle income working families. Now, if you're retired, you're rich, it doesn't hurt you. You say, well, yeah, it does, because I'm retired, I'm on a fixed income. Possibly so, quite possibly. It affects all of us, either irritates us and we spend less money doing things, or really, if you're trying to raise a family and buy groceries, as we all know, really tough, really, really tough. So 9 and 6 means prices are what? 15%. I know it's not compounded, it's higher than that, but 15-ish% higher than prices were. That's not good. That's really, really bad. So interest rates are being pumped up. Okay, we all know that. That's not telling anybody anything. But now we're waiting for things to break, because the Federal Reserve needs to break the market. It can't be red hot anymore. You can't borrow money at 0 interest and then go out and take risk like crazy. So what do? We have cyber currencies. I don't even know what you call them. I don't know that they're currencies, but anyway, you have cyber currency that is blowing up. We've got the meme stocks blowing up. People aren't gambling on their phones anymore in AMC and other little stocks. They're not. We blow them up. Job number 1, done. No more gambling. Number 2, gone. Done. Now, what are the unintended consequences? Oh, you mean it's not just really dumb people gambling on their phones? Oh, you mean it's bad bankers, bad management that shouldn't have been buying 10-year bonds at 1%. And only paying attention to checking the right boxes of who we hire and have on our board. We actually have risk managers and things. Regulators that weren't looking because they're nice people. Why would we bother them? They vote correctly. They're like us. All of those things are just bad decisions, and now snap. We're trying to figure out what's going on, but I'm not saying at all that this is the end of it. This is bad policy decisions for a long time. Now it seems abundantly clear that we're heading to a recession. What does that mean? Well, why don't we sidestep, because recession means that portfolios are going to go down? No, everybody's assuming it's already built in. In other words, the market is down, let's call it 20, okay, overall. I know tech stocks are up this week, the market's down, and however you measure it, everybody has a different thing that they're trying to measure. But what I do know is that now we can get some interest, and in some cases, a lot of interest on bonds and bond-like things, like the preferred stocks and all these other things. I don't need to get into the weeds, but all these things are now paying interest that weren't. So we can literally say, I think, as I've been saying on these meetings, it seems clear to me that we have more chance of success than in the last 12 years of producing 4 or 5% cost of living adjusted income all the days of your life, no matter how long you live. In other words, what every retiree wants. We have a better chance than any time in the last 12 years. Much lower risk. We can actually do that, and you're seeing some of that happen in real time in your portfolios as we transition. Some of those things out there are getting 6 and 7%. It's for minuscule risk. That's really good. for us. But in order to have gotten there, we have to go through these crises. We do. We can't get to the other side of interest rates going up massively in a short period of time, bad policy decisions, too much money thrown at things, quickly change, don't worry, people don't need to work, stay at home in your basement. Gosh, it's dangerous out there. You need to just stay home and play video games, never go back to work. What could possibly go wrong? We're seeing that. It takes time. So don't panic about it taking time. When we look back in a few years, it's not going to look like a lot of time. It'll look like we worked it off. So that's how we're thinking about this, quotes, financial crisis and what's going on. And I want to use this, some of our remaining time. We got time left, don't we, Jen? What are we looking at? Yeah. I got a little time. I want to go through a couple more slides to, again, put us in the place that we understand, because the thing is markets work. And over the last 20 years, we've had some terrible, terrible markets, right? I mean, some really big bear markets, frightening stuff, COVIDs, all those things, markets pounding down, right? So let's take a look. All right. So if we were to say, I just want to put it in a 10-year treasury, we hear this all the time, or 20-year. I just want bonds because I can get 4%. Well, today it's 3.7 for a 10-year or 20-year treasury, 3.7. If you look closely at the chart, you'll see it's 5.7 was the interest rate, which means you're going to get 28,000 gross, not net of inflation, for 20 years. Get less money back after inflation, real money, right? Okay. So that sounds good to a lot of people. Why? Because we don't want any risk. We want no risk in our portfolios. But we don't think about inflation until we have periods like this. Even if it's 2 or 3%, it eats away. And the things that retirees want and need, healthcare, travel, they're not up 3 or 4% over the last 20 years. They're up much more. Okay, so let's take a look at another alternative. And that's just called put the money in ICA, Investment Company of America. Now, why do we like ICA? Because they have the best little folder. They do. This is so cool. We're not going to have time today to talk about Louis the Losers, but for those of you who heard me last Saturday with Terry, a phone caller, ask about Louis the Loser, even he's in there now. Okay. All right. So buying at the worst time or the best time every year, and how little difference it really makes. This is the fixation of people. I don't just want to own Apple for the next 30 years. I want to think about it and grind on it every day. Should I buy here or there? No, just own it. Own the great corporations of the world. And that's what I want to touch on again. But you look how much money, how much more money they get to take out by taking out 4% a year and increasing it by the rate of inflation. I know everybody focuses on that. Wow, it's worth $1 million. I'm focused on the income of 537,000 versus, what was the other one, Jen? Bam, there you go, 574. Now here's the problem. What are we going to do the next 20 years? Well, I don't have 20 years. I get it. Okay. So the point being is we're up to 35, which is where you ought to be. And now we're up to 36 and then 38 and so on to keep up with the rate of inflation. It works. And by the way, before I forget, because I will, if you want this beautiful thing to share with your children, gather them around and teach your grandkids something about it, we can send this to you electronically. Just send us an email. Okay. Give us a call, whatever it is. It is really fun. I use it all the time. I really do. Why? I know what's in here because I just go back and it helps me to center my thoughts on what's important in investing, not the noise every day. There's so much noise. It affects us too. It really does. This is why we take the time to take these things to talk to you, because it helps dial all the noise down. It makes clarity possible. Okay? Not clarity about what's coming, clarity about how we should be acting in it. Okay? All right, so let's go to the next slide. This I'll go through fast because you've seen it before. This is the income story, but it's the greatest story never told. I don't know anybody that tells this story but us. I literally have never seen it. And we've been talking about what, Jen, 30, 25 years, something like that? Forever.
Yeah, forever.
Forever. Because it's just the easiest story in the world. I don't want everybody looking over to the right now. Just trust me on this, okay? It's a lot more fun if you just look at the left side. We pretend it's 1970 again, and we put $100,000. Good job, Jen. Don't let them go.
Sorry, I was trying to make
Yeah,
this.
just take it away. I know, now everybody, I've just made everybody look now, haven't I?
Yeah, there you go.
Right? Don't look at the accident. Oh, I can't help it. Okay, I know. All right, so we've got 1970. Why did we pick that time? I want to real quickly say this. We picked that time because it's the worst possible time for America, for stocks, the economy, inflation, everything else. You couldn't pick a worse time. That's because we always do this with our a hypothesis is not to be something you try to prove right. You try to prove it wrong. If you have a hypothesis that stocks can work, you pick a bad time to start doing it. A time where the market itself moves sideways like forever, and there's horrible problems in the world. Inflation, 50% market decline. We had Watergate. Then we had Jimmy Carter. And then Reagan, right after taking office, was shot. Now, I just went through the Reagan library, and a little sidebar here. I'll be right back with you. Don't miss it if you are in the LA area. It is an unbelievable experience. It truly is remarkable, emotional. It's a work of art. Never seen anything like it. Fantastic. All right, so Reagan gets shot. Okay, and then we enter into this period of time where the Soviet Union was a real deal problem. Yeah, I know they're back and China's a problem now and all this. Okay, but what I'm saying is this was a period where I started in the industry. The Soviet Union was a real deal problem for us to deal with. The stock market crashed. We had bank failures, Gulf War, and let's remember now, let's go to our income piece. We started with 3,400 in the middle here. See that? By the end of this page, we're at 13,000, 400% increase in spite of everything going on in the world. Our income, and we took every dime out. That's how that income grew, not from compounding it. And we've taken out 156,000 out of our 100,000. Next page, please. We keep rolling because all we care about is our income coming in. And look at that column. It just keeps rising year after year after year. Frankly, I will tell you right now, it's gone up on an average of 9% a year, 3 times the rate of inflation. Isn't that precisely what we want? During this period of time, it was no walk in the park. It looks like a walk in the park in hindsight, but we had Y2K. Remember, the world was going to all crash at that time. That's what all the talking heads told us. Get out, buy silver, buy gold, get out, sell your house. It's terrible. 6 rate increases. The first of several Asian crises came on. Remember, currency, and then we had bird flu, we had all that stuff, right? Okay, SARS, all those things. We had another 50% drop in 2001. The tech bubble blew up. We had 9/11 right after that. Yeah, a piece of cake, walk in the park. But look at the income. It keeps going higher. Another 2008. The whole world is ending a real deal banking crisis globally, leading to many of our really bad decisions today. And then we got to hear about Europe. You've heard all this before. And then politics, we can count on them to solve problems, right? No, it's never been this bad. Yeah, it was in the 60s. Actually, we had terrorist groups that killed people. It's terrible. How's your income doing? We're up to $55,000 a year, $883,000. Next page, I'm almost done. Don't lose me now. Then we go through this really calm period where politics calmed down, where the news media was never biased. It was just kind of putting the news out, right? They weren't trying to amp people up at all. It was a really calm period. And the income keeps rising. So we finished last year with $72,000, 1.1 million. You don't get to live forever, I am so sorry to say. Actually, I am. Life's pretty good. And your kids will receive 4.1 million. You, of the only importance on this, received over $1 million on your 100,000. Now, one thing you might notice is 2021 to 2022, you quote, lost $1 million. Oh, we shouldn't have done that. Yeah. The only thing that matters is that over this period of time, it worked beautifully, perfectly. You took income and you never had to do anything except behave. This is the S&P 500. And what you have in an income portfolio are these types of companies that raise their dividends every year. But you also find they exclude the Googles and Amazons and many others that don't pay any dividend. It's the good, the bad, and the ugly is the S&P 500. It's great companies that raise their dividends year after year, decade after decade. And some go out of business. Those are the ugly ones. And some that are great growth stories. That's the income story. And we're trying to mix in a portfolio. Yeah, you got some bonds. Now we can get 4%. We can get 6% on others. But put feeding in there so it's not all stocks. But it's a process to get there. You don't just like go, oh, we need to sell now and move it. Everybody thinks all or none. Don't think all or none. Process. Breathe. We tell ourselves that every single day. Human beings are emotional creatures. That's all we are. We are simply souls wrapped in skin, raw, pure emotion. We don't think so. We think we're above that. But let's not spend our emotions on finances. Waste your time in front of the box, hearing the same stuff over, adding what kind of clarity? Save our emotions for things that matter. That's why we are emotional. We're not emotional. God didn't make us emotional so we can waste it on our finances, so we can waste it on each other. That is the key to investing, is to put it down, walk away, and know it'll work, because it always does. Let's grab some questions, Jen.
All right. It looks like everyone still has a lot of questions on banking. So,
okay, good.
One of them, question, is it true that the top officers of SVB can earn salaries and bonuses because of accounting treatment of bond investments?
You mean they can earn it because of that? That's what caused the accounting of the bonds, meaning the price to market that they had to liquidate bankrupted the bank. I'm fairly sure that their bonuses that they paid out in prior years are safe. I doubt that that they're going to be able to keep all of their gains from selling all of their stock, knowing they were going out of business, knowing they were dying. They didn't share that information with people. I think the SEC is going to find some wrongdoing in that. And if any of them are paid a bonus this year, I would be stunned. I think that would be a political nightmare for those people. I just don't think anybody's going to let them get away with it, no matter how woke they are. Okay. If we can, let's take some of these questions. I see we do have a lot. Let's take some of them, Jen, if you can, kind of combine them.
And some of them were initially, some people are having audio issues. I know when Zoom updates, for some reason, people lose their audio. We struggled with that as well. So a lot of it was one of the questions also is there was no risk manager. What about accounting firms that were auditing SVB?
That's a great point. Boy, I tell you what, that is a super great point. Here's the problem I have with just throwing them under the bus like everybody would. Why would they necessarily be accounting for that they were correctly buying bonds? I don't think they would. I think that the actual auditors are supposed to, meaning the feds, okay? The feds are coming in, making sure that the risk is balancing out with their portfolio, that they meet the adequate ratios. But if they're sitting there saying to the accounting firm, why didn't you go in and value the bonds and then do this and this? I think they're there to balance what their balance sheet looks like and things like that. I'm not sure. So it's a great question. I think those questions should be asked, and they need to be coming clean one way or another. I just don't know that the accounting firms are at fault here. It depends on their job. I, first of all, blame the management, of course, okay? No risk manager. I blame the regulators for them allowing the 16th largest bank in the country to not have a risk manager in place. I can't even believe it. That is beyond comprehension to me. Everyone at the Federal Reserve in San Francisco should be fired. I'm quite sure that the governor there will not become the vice chair, because clearly she's incompetent. If her whole staff doesn't even look at a bank right down the street that did what they did. Unbelievable. It's just unreal to me. We don't need more laws. Actually, how about you just enforce the ones you have, right?
Yep.
Anyway.
All right, one more, and I think that's, and unless others, please, if I missed you, please restate it, because they did pack in there a little bit. Banks that are investing into Republic, is that depositor money, and is that appropriate?
Yes, and yes, it is. It's depositor money. It's their corporate money. It's just money. It's all on the same balance sheet. Are they taking specifically depositors' money? No, it's the value. It's the bank money. As long as their ratios stay safe, then they're more than happy to go in and buy assets of a faulty bank at a discount and try to make money on it. No different than they're going to be using depositors' money to go out and buy bonds to make loans. Are they using your deposits to make loans? Yes, they are. Some of them will go bad. But the answer is yes, of course. It's all really in the same bucket. It's not like saying, no, we'll only allow banks to do this little piece over there. Well, that's silly. You can't separate money. It's like separating water. We'll only use this bit of the water in the bucket. No, you won't. You'll use all of it. You know, if you're taking a cup out, you're taking a cup out. And that includes all money in the bank. Okay.
Maria, did we get all your questions? If not, please let me know and I can unmute you and you can ask them, but I think I gotcha. Anybody else? All right.
You can always stop me at the end if we have one more popping in, okay? But I want to remind people of a couple of things, okay? This is an emotional battle. It always is. It always has been. 10%, as you saw on our slide of the income story, is exactly the rate of return after this bear market, after 2022, for the last 50 years that slide represents. It works, it's real, it's 10. It's the only way you get 10. It's the only way you get cost of living adjusted income. We, of course, are taking steps whenever we can to make sure your income is safer. So for people who are in a growth mode, it's been a tough haul. It doesn't mean you still shouldn't own Apple and Google, et cetera. But for people in an income portfolio, it's gotten easier. I know the account value is down a little bit. Not as much in the market, I understand, but it is down a little bit. And if you wanted to sell everything, that's a bad idea. But looking forward, it looks more certain to me in any way we look at it, that you're going to be able to draw your cost of living adjusted income all the days of your life, no matter how long you live. And that's what we're trying to do. Not try to figure out what sectors to buy, when to exactly get in. So don't forget, you try to do that. Remember the Wall Street experts? They're wrong more than a coin flip. Why are we expending any file space, any emotions we have on that stuff when it's always wrong? It's wrong more than a coin flip. That's seemingly impossible, isn't it? How can you be wrong more than a coin flip without trying to be wrong? It's because we just get emotional, we're misled, and emotions are almost always wrong. These are the kind of things that help us. If it can help you, shoot us an email. We'd be happy to send you a digital copy of it. Pick one up at the office, whatever. But these things are great to just kind of go through the stories. Why do we like this fund? We don't even use it because they have the best brochure in the business. That's why. And they've been around since the 1930s. So we have a lot of fun history to go through. World wars, all those things that are in here and talked about. And that's why we kind of get back, because today is the only emotion you can have right now. you don't have emotions about how bad it was to look up in the sky and see Sputnik circling the Earth in the early 1960s. We couldn't do that. The people that swore our death could. That's how the space program started. Frightening things that we don't often think about and have emotions. The only emotions we ever have is because Hollywood gets us all upset because boy meets girl, fall in love, blah, blah, blah. And we get to cry because he dies in the end in the war. But we don't feel it. We don't feel the impact of that. We don't feel the financial crisis of past. We only feel now. And the only reason why is because right now we have not resolved the problems yet. When we do, we'll just move on to the next set of problems. And the talking heads can all babble about how the world is ending. And this time we mean it. All right, with that, let's go ahead and go forth. Have a great day.
Wait, I have one question for you because I think it is on top of people's mind too, is the whole SIPC, FDIC insurance. Because good. I've got a lot of questions on that. So can you take a minute and explain the difference, please?
Absolutely. First of all, SIPC is what your accounts with any brokerage are covered by, okay? And many of you have account balances that are worth more than $500,000, okay? That's absolutely true, and so is the pension funds and all the others that are worth billions are held in investment banks. So SIPC extra insurance is bought by everybody so that the accounts are unlimited, except for cash. Cash in accounts is limited to the $500,000. That's always been true. And there's really no reason to think they could go out of business because all they do is custody assets. That's all they do. Custody means this. I buy Apple for Jennifer's account, okay? So Jennifer owns 100 shares of Apple in her account. I don't have it. We custody it. Why do we custody it? Well, because it keeps you safe from Bernie Madoffs of the world. You know, hey, I'll just tell you, I wouldn't steal your money, but you don't have to even worry about that because I can't, okay? Because it's custodied somewhere else. And that's what Schwab does. That's what TD Ameritrade does. So they're custody banks. They don't do investment banking. They don't go out and try to figure out what new Silicon Valley venture is going to be there, which is why SIPC is incredibly cheap insurance to buy. And I know of no institutions that don't buy an unlimited amount because there's no way you can have, well, yeah, people hold billions of dollars in brokerage accounts. I mean, trillions collectively, but I mean, there's billion-dollar pension funds out there, multi-billion-dollar pension funds. You have to hold that and be able to insure it. So SIPC, FDIC, well, there's the moral hazard. Are we walking down a national banking road? There's a lot of pushback other than Elizabeth Warren. She wants those national banks. But that's one thing that makes America so unbelievably great is our community banks, our regional banks are the ones that lend money to everybody, from farmers to developers. It's not JP Morgan coming in and putting in the infrastructure, borrowing money. That's Mountain West. That's Key Bank. That's ICCU. If they're all gone, small business is going to struggle like it does everywhere in the world but America. Isn't that interesting? The job creation is fantastic in America because of small business, not large. You hear about the big layoffs, but people misunderstand it completely. Millions of small businesses hiring one people is a lot of jobs, or two, or three. One firm laying off 10,000 makes the headlines. But all of the employment in the United States for the last 25 years, all of the growth of employment comes from small business. They exist because of community banks. I think that people understand that, except for a few, understand that. And they know that that's one of the things that makes America's economy so unbelievable compared to everywhere else in the world. Remarkable. We really are remarkable.
I would just want to add real quick on the SIPC, if you don't mind. It's really for fraud. See, if TD Ameritrade went away 100% and they existed no longer, it doesn't mean you don't own the securities in that account. that insurance is so cheap because
Important point.
they would have taken those securities and they go away. It's for fraud against your account. There's no insurance, again, we all know this, for market risk at all. So that's not what it's for, because if Apple went to zero, you lose that money. So that's not what the insurance is for. The SIPC is very similar too, or FDIC is similar because they insure up to a certain amount, and above that is at risk at the banks. But that's different completely than the SIPC. And that's what people have been worried about. Okay.
Great point, Jennifer. Thank you for clarifying that.
Yeah, absolutely.
Good.
I think that's it. I don't know that there's any other questions.
Well, then let's say goodbye, everybody. Have a good weekend. And let's not try to look too hard. It's never good. It's never good news. But this too shall pass. Have a great rest of the day and great weekend. Thanks.